welcome everyone to episode 54 of Top of Mind with Consilio Wealth. Hal and I are back today. It is Wednesday, 7/24. We're recording this episode a little bit early this week because Hal's got a little trip at the end of the week. And on today's episode, we're going to be covering 4 items. First and foremost, 3 stocks have driven 50% of the S&P 500 gain in the first half of the year. Do you know what 3 of those are? We will unpack that today. And number 2 is, anyone notice the small cap rally? Small caps have crushed it over the last couple of weeks. We have some insights on why we think that is, but small caps are not reported on nearly as much. You know, when you flick on the TV or you turn on Yahoo Finance or whatever, it's always the S&P, the Dow, the NASDAQ. You almost have to search to find small caps, and they've been crushing it the last couple of weeks. Next up, beware of the market making an assumption around the president. We've talked about this a lot. I anticipate this to be a recurring theme of ours in the next couple of months as we barrel closer to the elections. But we just had some continued insights on what the market's predicting there and our thoughts on it. And finally, what's your stock of the year? NVIDIA? That's what I thought you'd say. How about another one? We got another one. We got a bonus one. The stock.
Not investment advice, though, either.
Not investment advice. Because this is, of course, backward looking in hindsight. Yes. But the stock that has outperformed NVIDIA in the trailing year is... Stay listening, and we will unpack that at the end of our episode.
What a teaser.
Oh, man. This is going to be fun. All right. So, top 3 stocks that have driven 50% of the S&P gain. How, take it away.
Top 3 stocks probably shouldn't surprise you, right? NVIDIA, Alphabet, and Microsoft. And this was before this rotation, which is probably our next story, if I was listening to Chris correctly. Yes, our next story. So this might change, and maybe we said we told you so. I think the past few episodes, the theme was the top dogs always get knocked off their perch. But let's focus on the top dogs for the time being. The concentration risk, right? Yeah. So NVIDIA, Alphabet, or Google, and Microsoft collectively posted a 49.3% gain from January to June. And I know it's about 25 days stale from like the cutoff date, but still, that's how powerful this rally for the first half for big cap tech companies, where they were making money hand over fist. And really, the narrative there is, we're going to build out AI, we're going to make everyone's lives better, and we're going to make a boatload of money off of it. So what's happening now, right? I think the question, was raised with Gemini in Google. Remember Google's snafu with Gemini? It's like, hey, can you pull me a picture of Nazis?
Yep.
And they would generate pictures of an Asian woman or an Indian man or a black person, all in Nazi paraphernalia, which
is inaccurate.
Yeah, wildly inaccurate.
I also heard, as a quick side note, I heard that it was telling people to eat a rock every day. You know, like that was good advice. And there's one other thing I'm forgetting now. I was reading this article on like the early releases of Gemini, and so they obviously had to pump the brakes on that. So
yeah.
That's not good.
And I think, well, it has to be trained on something. So let's say you let it loose on the World Wide Web. How much toxic trash are you putting into your model?
A lot, probably.
So I think what I'm getting at is the equation with all the spending is, one, how are you making money? And how are you monetizing, if you're able to monetize, right? So far, it's been a pretty lackluster track record. Look at Dell. Dell said they came out, it's like, we sold all this infrastructure build out. We make 0% profits on this.
I think this will be interesting. I read this recently. There's a 500 million, can't be billion, $500 million gap between what companies have spent and what companies anticipate to actually receive in terms of revenues from AI.
Yeah, collectively, that's a B.
It is a B?
Billion.
Thank you.
Yeah.
That's a big number.
Yeah, market cap growth was in the trillions.
Yeah,
so investors have already priced in, so to speak, all the anticipated growth from revenue.
Fair point, because you said these three companies have gained 2.85 trillion in market cap. So if there's a $500 billion gap between what these companies anticipate to recoup in terms of revenues and what they're spending, the market is pricing in or wishing for some sort of almost like a miracle on somebody's going to be the clear winner here and get all the profit.
Yeah.
Currently it's NVIDIA. But we'll see who that
Currently
is.
it's NVIDIA. So as of June 2024, the top 10 stocks account for 35% of, like in terms of weighting, they account for 36% of the U.S. stock market, the S&P 500.
Mm-hmm.
That's a historically heavy concentration. Mm-hmm. And if you break down that concentration, they are sensitive to technology cycles, right? So you got Apple, Microsoft, NVIDIA, Netflix, all are going to trade in high correlation or lockstep with each other. So if Apple sinks, it's very likely everything else is sinking for whatever reason.
Right. This is a wild chart. I just have to pause here and call this out for a minute. So June of 2024 versus July of 2019. So if we look at those two date frames, Microsoft in July of 2019 had a 4.19% weight in the S&P 500. Today, 7.25. That's significant. Apple in 2019, 3.74. Today, 6.62. NVIDIA, not even listed in 2019. It was a tiny company. Today, that's 6.63. Amazon, interestingly, is about the same, 3.10 to 3.86. And finally here, Meta, 1.87% in 2019, 2.41% in 2024. That's just wild.
And we're talking trillions of dollars. Like we're past the B, or a capital B, billions.
We're in the T's.
Yeah, the TR. It's talking an insane amount of money in terms of market cap growth. And are we saying it's too much too soon? I don't know. What do you think about all this?
Yeah, we won't know until we're through it all, right?
Yeah.
I mean, definitely what's happening is the market's pricing in all of these companies will be winners, right? But there's very few. And I mean, we've been approached by a couple of different sort of AI finance tools. And frankly, the amount of money that they're charging is like nothing. You know, that they're charging, I guess I'll put it to you this way. For if you consider a service that's outsourced that you're paying real humans to do, that are, behind the scenes, and of course the scalability of that is, us as a firm, we can pay, X dollars a month and get access to 6 people on the other side, fractionally, right? But these AI tools are pricing themselves as far, far, far below fractional, 6 people. I don't know how they're going to make money. I mean, they have to be massive scale.
Yeah, maybe that's the Uber model where you undercut fares to kind of push out the taxi industry, right? Because remember, Uber fares were so cheap. Then all of a sudden, Uber as a company. That. Yeah.
Now I don't Uber anymore. It's too expensive.
Well, they got to make profits all of a sudden, right? And versus.
What do you know? They're wildly profitable. Yeah.
Yeah.
But that only works until the money runs out. Right? Because that's kind of what happened in the markets. You saw companies like Netflix getting tanked because Wall Street was like, what's your business model again? You guys just spend tons of money basically making all your productions and whatnot. They had by far the highest budget for spend. I think it was something like $1 billion of content per dollar spent as a user. Something insane. No one even is close to that. And so, Wall Street's like, hey guys, like, what's your model? And they've had to dramatically reel in their spending and show that they have a business model to make profit. So I think everything kind of works like that, right? It goes in this massive spend when easy money is available, which I don't know that today's era is easy money. But then at some point, valuations start to say, show me how you're going to make money. For big tech, this could end up being huge losses, right? If ultimately they're not making the revenue that it's going to take to support these systems, because we know how costly they are from a chip standpoint all the way down to an electric standpoint.
Yeah, check out our post, what if AI is a dud? Mm-hmm. The build out, though, might be fruitful for another technology. Just slap a new label on the technological advance, right? If it's not AI, it is something else. That's the trend we've been on for the last 30 plus years. So is it going to be autonomous vehicles? You still need GPUs for that, and extreme processing power.
Yep.
Or something like might spoil it, but something like, how many pants do I need to order for this Christmas rush coming up?
Sure.
Right? Have the AI do it. So something that outside of the general sense, like ChatGPT, yes, has probably been in the spotlight, but I think the true special benefit from AI is going to be data analysis and behind the scenes stuff we won't see.
It's interesting because Amazon's done some of that stuff. Like if you have a t-shirt company and you do it through Amazon will just print the shirt when somebody orders it, which is pretty cool, right? Versus having to order 1,000 of each size and hope that you can sell them. In fact, there was a company that I followed. It was one of these I actually bought something on Instagram, Instagram ad. Cool company, cool jacket, bought it, and he ended up going out of business. And I got all these emails as he was trying to close out and sell his inventory, huge discounts and stuff. And he just kept emailing because he was trying to sell his remaining inventory. And I just thought to myself, man, he had to go and buy all these jackets and whatever and then hope to sell them. If he could have had some sort of demand forecasting or just in time model, all he had to do was make the design, make 10 jackets, take some pictures, put them on the internet.
Yeah.
And as they sell, you make them. You don't have the risk. You don't have the downside risk.
Correct.
Amazon's been doing this forever, but I can't help but wonder how AI is going to help them get more efficient.
Yes.
In that
bit of a
type
tease,
thing.
I guess.
Yeah. Well, should we shift to small caps?
Yeah, let's do it.
Let's shift to small caps. Yeah. So what's going on in small caps in the last couple of weeks? This has been impressive, and we've been talking about it for a while. But what's been going on?
I know it's finally come to roost, right? We've been saying, one, stop chasing recent high performers, because you don't. If I bought NVIDIA, I don't get 300% returns in my pocket, right?
Totally.
If I buy NVIDIA today, I have to the unknown. Can NVIDIA return 300% over the next 3 years? Who knows? Is it likely? Probably not. So that's investing, right? You got to answer these questions when you're buying and selling something, right? Because if I'm selling and it goes higher, well, hindsight says I sold too early, but that's the issue with this. We bring up small caps because if anyone's paying attention to the markets as closely as we do, small caps have lapped the S&P 500 tenfold.
Yeah.
So the first story was how concentrated the S&P was, but the more recent story is how many investors or how many dollars rotated out of the Magnificent Seven and into smaller and mid-cap companies. And it's violent. So Reuben Miller posted a pretty good quote, and I believe in this too, is over the last 6 months, the tiniest unknown companies have outperformed the largest famous companies. But in the last, as you can see, it was all that 6-month performance was condensed in 1 week. So yes, small caps have outperformed the biggest companies over the last 6 months, but it was all due to 1 week performance. So that happens in spurts, meaning if you weren't holding small caps, rotating now, you might have missed probably the most powerful portion of the return stream there. Because we say best times to buy is right in the middle of a sell-off, because the next few days tends to be the sharpest rebounds. Similar here, where if you look at small mid-cap, like in a bubble, they were pretty flat from 2022. nothing like the high-flying names of the S&P 500 and the S&P 500 itself over the last 18 months. I think that's a big lesson for people who had not enough exposure or underexposure to small and mid-cap companies.
I mean, as I look back at this S&P 500 list, I think the only one that moved from more of a mid-sized company to large is NVIDIA, right? I mean, NVIDIA was in the S&P, but it was much, much smaller weight. And so, that's kind of what, it's the Amazons of the IPO moving to the Amazons of today. That's why you buy small caps. And so it's just been good to see it finally start to pop again.
Yeah, and I think owning small caps, you're owning probably at least a portion of our favorite stock of the year, which we'll get to, which is graduating to mid cap because it's done so well. It's getting booted out of the small cap index and being invited happily into the mid cap index.
Look at that.
If you have all S&P, you owned none of this company.
Interesting. The teaser gets better and better.
We're just going to tease the whole episode.
I want to spend just a minute on the Russell 2000 index versus the S&P 600. The Russell 2000 index is the 2,000 smallest companies that are publicly traded here in the U.S.
And Apple's bigger than all 2,000 combined.
Thank you. Apple's bigger than all 2,000 combined, which is just kind of wild to think about.
Yeah.
Think about how many companies you're getting access to in the Russell 2000 versus Apple, which is a lot of, one could argue is a lot of companies within a big company, but it's not 2,000. The S&P 600 is the 600 smallest companies in the U.S. that, again, trade on that index. Now, the difference between the two is that the S&P has a profit metric in order to be in their index. The Russell 2000 does not. And if you remember a handful of episodes ago, we came out and said, or at least posed the question, is the Russell 2000 a broken index? Because the increase of unprofitable companies, or the rise of profitable companies in the Russell has been going up. And so we said, well, why would anybody buy this junk index? It's just owning a bunch of unprofitable, junky companies. Well, we stretched that out over a period of history. And there are times where markets reward unprofitable companies more than profitable companies, so-called junk rallies, or there's various terms on these. The latest one that you all might remember was COVID. COVID was a junk rally for a lot of companies. You had companies that were valued far, far higher than their revenues and their profit growth, far over the tips of their skis, and obviously many of those companies have sold back off. So with that setup, How I just want to talk just for a minute about how has the Russell 2000 done?
Yep.
Versus the S&P 600, both small cap index. How have those done over the time period that we're looking at here?
Yeah, year to date, they are admittedly lagging the S&P through. This was before this mini sell-off that we're going through. S&P was up 18% year to date, and Russell 2000 was up 11% year to date, and mid-cap was up 8.73 year to date. I know we use the Russell 2000 as more of the proxy because we think there are better ways to access small cap, as Chris mentioned, the S&P 600. So the S&P 600 year to date is up 8%. And let me refix some of these numbers because the chart I had was through early July. The Russell is up 11.51. So
8 versus 11.51.
Yeah, notable gap there.
Huge gap.
Yeah.
So has this been a junk rally?
I would say so. Mini junk rally. Some people call it a rotation, right? You're rotating out of your winners and into some overlooked losers, which happens to be small caps. All right.
What's your theory? What's your theory on why? Let's stick with junk rally as a thought. What's your theory on why those stocks have done better than more profitable companies during this time?
Yeah. Oh, great. Actually, really great question. That's kind of been plaguing the small cap since 2022, so over the past 18 months, is high interest rates. Unprofitable companies need what to operate? Debt. They need loans, right? And a lot of it is floating. So the higher the interest rates go, the more expensive that debt becomes for them. And some of these companies are pretty highly levered because they make no profits yet. So what's been happening is really been the story for the past 18 months as well is interest rates. Interest rates have finally peaked. And they peaked, last year, but there's a pathway downward, right? It looks like we have 100% odds of a rate cut, of at least one rate cut in September, and 2 more rate cuts after that, November, December. So we're looking at 3 potential rate cuts.
So that makes sense, right? You've got companies that are not profitable, and the market is saying, well, maybe these companies can turn a profit if the cost of their operations goes down, versus the companies that are already profitable might not have as much of a swing as rates come down. Interestingly, that makes sense, that kind of the junk rally popped more.
And I think that's the U.S. capitalism structure working, right? Because imagine Uber surviving or Lyft surviving in a higher interest rate environment when those companies were debt laden and not making money.
Right. Interesting. All right, let's move on to market-based assumptions on the president. I feel like we're going to talk about this every 2 weeks, but it's an important message to carry on. So you had some insights here on energy sector and clean energy sector. So why don't you just unpack what we've got?
Yeah. This came up before the Biden dropout. So we had what's called the Trump trade, where Trumps were on favorite to win the presidency when Biden was in the mix. It was about the prediction markets. The one I saw the most favorable for Trump was 75-25 odds of him winning. Wow. And now Biden's dropped out. The whole thing's being reshaped. Yep. So leading up to that point, though, the certainty was building, and the trades have followed, meaning people were buying up oil and people were buying up financials, right? 2 things that the market was assuming, that as Trump comes in, he's going to be oil friendly and bank or regulatory friendly, which would help banks. Again, I didn't do a ton of research because I knew that was a bunk trade. We've been telling people not to trade with presidencies, and I went back to Trump's first presidency, because that's what's nice is you could go back to the first 4-year window from 2017 to 2021. Yeah. And all I did was compare clean energy. I used the iClean ETF. It was up 306% in those 4 years. Clean energy ETF. Old energy ETF was negative 29% during those 4 years. So if you're going to use the Trump trade, you didn't look back at those 4 years. One, what are you doing? Why are you deploying capital in that manner when history shows you that Trump was a very green president in terms of stock market performance?
I think it's worth noting here that presidents have almost zero influence over the stock market. And the reason why I call this out specifically here is that the chart on our screen shows that the vast majority of the run-up that how you just talked about for the clean energy ETF happened as a junk rally post-COVID. So it went from, I'm kind of ballparking here, it was up 100% to where, so clean energy was up 100%, old energy was down maybe 10. So still outperforming. And then the junk rally happened, so everything tanked, and then everything skyrocketed. Well, interestingly, oil tanked, but it didn't, it came back a little bit, but kind of flatlined. Remember negative oil prices? That was interesting. But yeah, clean energy spiked a lot. So that even furthers our point of saying, don't invest based on 2 points. Don't invest based on what you think a president's going to do for a specific sector. And secondly, this is exactly what we're talking about with the junk rally, because so many of these green energy companies are completely and horribly unprofitable.
Yep. And I think I was trying to be sarcastic about Trump being a green president. If you're if you're making that assumption, just as equal folly is using that chart to invest in if Trump were to win, invest into green energy.
Yeah.
And
try to chase it
energy.
again.
Yeah. Because one, Chris points out, COVID was right in the middle of that, and energy, like oil, remember, was negative $40 a barrel, and some schmuck in New York was sitting on oil futures. The problem is with the futures market is you got to take physical delivery. So if you live in an apartment, how many drums of oil can you fit in your New York apartment? In one future, I think it's like 500 barrels of oil. So some schmuck had to pay. You know, when oil was at full capacity, right? Our pipelines are full, our tankers were full, sitting out in the shores. Yeah. There was literally no space, so he had to pay $40 per barrel to store somewhere.
Yeah. Because
he got caught holding futures when they matured.
How did the story end up? I feel like we need to go then what?
Yeah.
And then what happened, you know?
Yeah, I think we brought up a story about egg futures, and a single egg futures contract is 2 tons of eggs. And the thing with futures contracts is when they mature on you, you have to take physical delivery, which is why only farmers and manufacturers trade on these things. And speculators probably shouldn't, but sometimes they do. One guy got caught with 5 egg contracts and had to take delivery on 10 tons of eggs. You know how many pallets that is?
No, I don't, but it's got to be a lot.
Yeah, that's probably like 100,000 eggs or something like that.
I mean, I'm thinking like a pallet that is maybe 2.5 feet tall of, like flagstones, like paving stones. That's like a ton. And those things are dense, right? Eggs? I mean, geez.
And you got to eat them within weeks because they're perishable, right?
And you can't freeze them.
You can't freeze them.
Where are you going to freeze them?
Yeah. So we're on this side tangent because what did Trump or even Biden have to do with egg futures or oil futures? Not a single iota, right? Oil production in the U.S. is at a record high, and guess who the biggest oil producer in the world is?
The U.S.
The U.S. By a long shot.
By a long shot.
So let's throw away presidential narratives. When you look at the media say Trump trade, just don't click on it because it just feeds this false narrative that you should invest in a certain way based on a president.
And now I'm hearing about Kamalanomics. It's like, oh boy.
Yeah, it's just one label after another.
Just stop.
And people like investing using phrases. Again, another newsletter on the Consilio blog website.
Mm-hmm.
It's not recommended. We're not here to make recommendations, but I wouldn't recommend.
We'll make that recommendation.
Yeah, I would not recommend investing using slogans because that's all these are, right? So if you allocated money because you thought Trump was going to win, I wish you luck. I wish you were doing a little bit better thorough research, but, I hope it works out.
Let's move to our new favorite stock of the year here. So we've been tracking this, and there's some interesting kind of articles on how this happened. But why don't you lead us to our punchline? What is the top performing stock of the trailing 12 months?
Yeah. People who've sat with us for 28 minutes, 29 minutes finally get it. It's Abercrombie and Fitch. Over the
Remember
last
that company?
Year. Yeah.
Who went there? Who went there 20 years ago?
Not me. I couldn't afford it, but
I remember you walk by in the mall and it's just like they must have cologne and fans, and it's just like blowing it out into the mall. And I remember going in there as a kid. It's dark. There's like spotlights pointing on the different, like you can barely see anything in there. The people that work there are kind of trained to be a little bit like spicy.
Yeah.
Like they're not super nice, not like they got kind of some attitude. It's not a very appealing place to go. But
there's a documentary on Netflix called White Hot. And part of the theme was to make the vibe more exclusive. So if you were relatively unattractive or outright ugly, they would unfortunately treat you as such, right? They would hire good-looking people to sell you stuff, and they had this air of snootiness about them when you walked in.
Interesting.
So if I walked in,
And that was the strategy.
yeah, if I walked in, which I didn't, but I probably would have been shooed out passive aggressively, because that 10 in there is looking down at me as a 6 or a 7 and say, you don't belong in this store.
Interesting. Okay, so what's the stock doing? Let's talk about the stock.
Yeah.
How did they do this?
Yeah, over the last year, sorry to use you as my therapy session.
No, that's great.
Over the last year, the Abercrombie stock is up 340% over the last year. Compare that to
Does
NVIDIA.
anybody out there own that stock?
If you
I
own small cap,
guarantee
you
you
do.
that 0 of our listeners, okay, sure, in an index,
Yeah.
but like as a call out. Like,
Yeah.
if I asked people to email us, do you own NVIDIA? We'd get so many emails. But go ahead, email us if you actually own Abercrombie stock, like straight, like not in an index,
Yes.
but like you bought it and you're up, 300% in the last year. Like, I want to hear
If
from
you
you.
owned it in the last year, up 340%, while you're happy with NVIDIA, you were up 179%. But owning NVIDIA, you were nearly double NVIDIA's return, like double for a clothing store.
And how'd they do it? Why are they being valued so highly right now?
Because they're making money. They're fundamentally turned around. So all this stuff that Chris and I talked about being booted out for being too ugly, they're not doing that anymore. Their appeal is more broad, more welcoming. In retail too, of all industries that have really been sucked dry by Amazon, they're one, broadening out their market base. Two, they're using AI in a really effective way, which I kind of led to earlier, where they're using AI to predict purchases, the demand that Chris was talking about with the guy selling T-shirts. That prevents one, inventory loss, right? So if pants go unsold, they're not throwing away tons of denim. They're throwing away maybe a dozen, right? And if the tastes change, they can quickly produce whatever, a new dress or a new shirt to quickly sell as the styles change. And I think that's been in effect for more than a year, and it's been hyper effective in terms of meeting demand. Abercrombie and Fitch internally calls it demand chasing. So their analytics was able to come up with a system to chase inventory demand, where let's say the Stanley Cup craze, just apply it to a specific T-shirt. Their AI was able to identify that and tell the factory to produce more of this shirt, and then have it sent automatically to the stores. So now you don't have purchasing managers, you don't have inventory counters. Have you worked in retail before, Chris? Did you ever have to do inventory runs where every quarter you had to count every little piece of inventory, and then you could figure out how much was actually sold or lost through shrinkage?
Yeah, we had to do inventory counts. We didn't do it every quarter, but we did it kind of as things just looked weird. We'd look at our inventory and we'd say there's 30,000 pieces of this thing out there, and you'd look and you're like, not that. So then we have to count and figure out what happened, and it's a painstaking process.
You want to talk about? I worked in Radio Shack. Remember Radio Shack?
Yeah, there's lots of units in there.
We sold lots of little transformers, little electronics pieces, and we had to count each and every single one every quarter.
Every quarter.
Yeah, imagine how inefficient that was.
Yeah.
And we would call them inventory runs, and we would work overnight because we couldn't count this stuff during business hours. And imagine counting a stack of batteries, and they're 50-cent batteries or something like that. Whatever was filled inside the Radio Shack, I had to count every 3 months.
Man, that's wild. Yeah, I worked for this glass company. We it was a recycled glass company, so we would recycle old bottles and windows and stuff like that, turn them into tile for like kitchen backsplashes and this kind of stuff. I worked there actually for a bunch of years, but cool company.
Yeah.
But yeah, when we would see in the computer, there's 30,000 tiles outside, and there was nowhere near that, or 30,000 2x2s, or whatever we were selling, and it's like no, and we'd have to do an inventory count. We'd be way off, and we'd always wonder why, but we also would be kind of running to the back, grabbing extra stuff, selling it in the front type thing, and so it would get out of hand pretty quickly.
Yeah.
Somebody comes in, they're like, hey, do you have more of this? It's like, yeah. And then, there wouldn't be that journal from kind of the back to the front, because we would just be kind of selling tile. And it'd get out of hand pretty quickly.
So Abercrombie solved this using AI, where if something wasn't selling, one, they didn't overproduce it, so it was easy to discard it or put it on reduced pricing.
Mm-hmm.
The real time sales and customer insight analytics help identify which products were appealing to the targets in spotting these micro trends in specific regions, right? So if someone in the South really like tank tops because it's warm down there,
Sure,
you would produce more tank tops in the South versus in the Pacific Northwest. So it was hyper localized and specific to the region, which I don't know why companies hadn't. Maybe they did. But
well, it sounds. I guess in a way it sounds expensive, right? Like a couple steps back to figure this out, but once you develop it to get the technology right, I mean, this is incredible. I just want to read and kind of paraphrase what you just said. Production cycles are shorter, which enables Abercrombie to react to emerging trends while avoiding overproducing and overstocking unpopular items. Real-time sales and customer insight data analytics help identify which products are appealing to target audiences and spot microtrends. These insights enable them to make informed choices on what to chase, which is their inventory strategy, and what to drop. A trade strategy may appear impulsive from the outside, but it requires flawless execution augmented by technology, which includes internet and AI to enable data-driven and agile decision-making. It's perfect. It's great.
Yeah. Yeah. And going back to our retail story, have you worked in a store where this specific item never went unsold, somehow always got replenished, like more inventory came in for it, but it was always collecting dust? Think about how common that is.
Right.
And how, in hindsight now, easy why wasn't that something that was solved decades ago?
Totally.
Yeah.
Anyway, I mean, this is cool. And I mean, it's kind of like, the story of the past is Domino's Pizza. Domino's Pizza said, let's become a tech company that sells pizza. And they completely revamped all of their systems to create their demand, to make their supply chain better. They improved their product, right? And now they're one of the biggest pizza chains out there.
Yep.
Similar stuff to what Abercrombie's doing. This is really cool.
Yeah. Let's talk about value investing. And this is a quintessential value stock up until this point. But Domino's Pizza was at a time too. So true value investing is picking distressed companies and waiting for a turnaround. Yeah, undervalued for a reason, right? The market knew Abercrombie was a struggling business, right? They cut their dividend in 2020, right? And they were going to go out of business. And their exclusivity and, attractiveness fencing had not really sat well with today's society, and they were a struggling business. But this performance that we're mentioning, this 340% over the last year, this kind of torrid pace really started just 3 years ago. Not even 3 years ago, 2 years ago, when they started improving their core business. They changed their marketing, obviously, and they went from a value company, right, distressed, almost out of business, to a growth company. They're also so successful that they are moving from the S&P 600, which is our preferred small cap ETF. Just as an aside, that's an ETF that screens for profitable small cap companies. So it should hold up better in a sell-off versus the Russell 2000, which throws everything in there. Going back to Abercrombie & Fitch, it's graduating from the S&P 600 to the S&P 400 because its success has taken its market cap up to upwards of $8 billion when it was sub $1 billion, right? Over the last 3 years, it went from a $1 billion company to an $8 billion company. And it is going from small cap index to a mid cap index. So our little baby is growing up.
It's important to note that it started, though, as a junk rally. I'm just looking at a chart that dates all the way back to 96 when this company went public. It went public at about $9 a share, somewhere in there, 9, 10, 11. And it hit that, again, multiple times. Hit that in 2017, $9. Hit that in 08, maybe like 10, maybe 20. But more recently in COVID, so May of 2020, this thing was sitting at $10. Went from $10 to like 42. Junk rally, right? And actually, as I look at their historical financials, although we know that they started doing this in 2019, it wasn't making any money until really like 2022. And now this year, they've actually grown sales and they've made more money. So it was a junk rally, right? It went to 40, and then it went all the way back down to like 12 or 14. And then from 2022 forward, it's just gone straight up. $22 to 157 right now.
After a sell-off.
It's off $5 today.
Yeah. So I think it's a AI story, it's a value story, it's a small cap story. Yep. And it's been ignored because all the focus was, well, why don't I just own 100% NVIDIA?
Yep.
Well, because the point of really investing is to be diversified, and part of diversification is picking up pools of risk here.
Yeah.
And one of those pools of risk is capturing Abercrombie and Fitch, right?
Yep.
So if you were S&P focused, you had no participation. And again, no one's 100% small cap, and the sizing is limited here, but that's how you get the Ubers before they're Uber, the Abercrombie and Fitch on the turnaround, the Domino's Pizza's on the turnaround. Domino's Pizza is still was a mid-cap company during its torrid run-up, right? If you picked them up only through the S&P 500, you missed a lot of those initial and more powerful gains, to be clear.
Great point.
So, yes, we've had to apologize for being diversified in a concentrated market rally. Probably not so much now because diversified portfolios are holding up much better than the S&P or the NASDAQ.
Never apologize for being diversified.
Never. And more like I told you so type of approach, but not to say that. But you see what I'm saying is like, yes, you have to watch companies skyrocket while you're holding a pretty responsible pool of assets.
Yeah.
And this goes with real estate. This goes with really anything that you see your neighbors doing, and FOMO sets in, right?
Yeah.
Because it always comes back.
Yeah.
It always reverts. And I think the point of today was really the small cap story and what's within that small cap story, right? Chris mentions junk rally, but it's not all junk, to be clear. It's somewhere in there is the next Amazon.
It's only like half junk. Russell 2000 is like half junk. Not all
2,000 companies. You just need a few actually to really pop. But you see what we're saying is don't chase returns because you see in the headlines, because NVIDIA does sell, right? If you're CNBC or CNN or whoever's writing financial media, I think you get more clicks by just putting NVIDIA in the headlines, right? And just a year ago was Tesla in the headlines. So ignore all that noise. Even with us too, it's like you probably shouldn't run to the investment bank and pick up Abercrombie and Fitch. But even though we think it's a special story, but a lot of the growth is already priced in. $8 billion compared to how much Nordstrom is, $3 billion. How big is Nordstrom relative to?
I was just looking at that. Nordstrom popped back off their low. No, $3 billion.
So,
wow.
So scaling matters in terms of what industry you're in. Can you see a $16 billion clothing retail store?
Nordstrom does about $15 billion of revenue, and they're worth $3.5 billion. Abercrombie is worth $8 billion, more than double, and they do $4.5 billion of revenue. But Abercrombie makes more money.
Yep. So you see what we're saying there is like, don't ignore the rest of the investing universe because something hot is out there.
Hold on, that's actually wild that Abercrombie in their little stores, that are in malls, does. And then think about Nordstrom, big stores, multiple floors, all different kinds of products, from purses to strollers to jeans to rain jackets, right? Abercrombie doesn't do half of that stuff, and they're at a third of the revenue. That's impressive. Like dollars per square foot, that's really impressive. And Nordstrom obviously sells higher end brands. You know, you could spend many hundreds of dollars on jeans there. I don't think Abercrombie is at that price point. That's actually really impressive. Like per square foot of retail space, they're selling a lot. That's impressive. Wow.
And I think that's what makes it a special story too, because the retail landscape overall is in a pretty large decline, right? Unless you're Amazon.
The Gap is also worth $8 billion market value. They do $15 billion of revenue. Makes more sense, right? Gap stores are a little bigger. I'm actually surprised. They must have more Gap stores than Nordstrom stores. I'm just thinking size, but there's just more stores. They about the same amount of revenue as Nordstrom. Man, Nordstrom's in trouble. That's my other takeaway here.
Don't short Nordstrom.
About Macy's. Okay, Macy's is worth $4.5 billion, and they do $24 billion of revenue. Wow. Interesting times in real estate. You know what Abercrombie should do is they should take this technology and they should sell it. They should license it out to all these other brands that can't seem to figure out what they figured out.
Or sell it to some tech companies that are really touting AI and really doing nothing with it, right? Because in personal opinion, honestly don't think generative AI is the future of AI. It's more back-end analytics.
Inventory management.
Yeah, doing something with it. Mm-hmm. Because Sports Illustrated started writing articles because they were bought out by private equity. Started writing articles using AI. Well, why don't I just type in a sports story request about a specific player on ChatGPT for myself, and there you go. You can't sell generative AI if you're someone who's producing it and try to sell it as this like a written article. That's the issue. That's a big issue.
You know what else is wild? Have you noticed when you Google something, you get an AI snippet now?
Gemini, yeah.
Mm-hmm. So I was just reading about this, and I have probably mistakenly read that and taken it as correct. I've read that it's not correct. You know, you think what it's doing is it's scraping the top hits and it's creating a summary for you.
No.
But I've read that it's actually, changing the actual words or whatever and giving you an incorrect response. And you just start thinking about like Google's model is all trained based on people clicking. Like you using Google and clicking on something, and they of course track bounce rate, right? If you click on something and you don't get the right result and you bounce, Google knows that.
Yeah.
And so like the top ranked hits when you search something are there for a reason, because most people will go there and stay there because it gives them the answer. And so if you think about that entire model, which is consistently trained and getting better based on user feedback, humans clicking buttons, and then trying to pivot that entire model into a GPT type snippet, that screws up everything that they do.
Yeah.
Because people don't click anymore if they're going to read the snippet. So, I mean, what
if you're getting ongoing training and it's starting to train itself on other AI produced stuff that probably isn't the most accurate, you're just creating this perpetuating cycle that's going to eventually be unusable.
What a conundrum, right? And it's their entire business model.
Yeah.
It's like they're creating one business model to cannibalize the other business model almost.
Correct, yeah, because it has to train on something. And
search and ads, that's all they do.
The New York Times, the paper of record, is suing ChatGPT because you're training on copyrighted information to produce similar tone, similar cadence, and all that stuff as the New York Times. whose work is it ultimately? Right? And I think that's going to be the question. I think generative AI probably isn't the answer for AI, but I think AI broadly is the answer for a lot of other things. And the use case for Abercrombie is just one.
Yeah. Well, and it's all just about how all this evolves, right? If the generative AI piece can build, then that can be applied so many other places, right? 'Cause so many of these technologies start in infancy in a completely different area, and then they pivot into something better. But obviously, all these LLMs and whatnot that are being built probably are all necessary to reach the final objective.
Correct.
Which we don't know what that is yet.
We don't know. Yeah, and there's going to be growing pains for sure.
Oh yeah.
Yeah, but the way it's kind of being sold and presented, I just don't see a pathway for that specific thing.
And we'll see how the market reacts too, right? As these companies keep spending billions and
it's in the show me
revenue.
state, right? Like, show me the profits. You got to make money off this big investment.
Yeah, it's in the race state too. Because if you don't do it, you're behind. And if you do it, you better figure out how to make money at it. But the market hasn't rewarded or punished companies for not making money yet. That time will come at some point.
Yeah,
has to.
Yeah, the bill's going to come due, and I think that's probably the part of the equation for the large cap companies.
Yeah, that
have probably benefited the most, at least with the earnings calls, saying we're building out AI, we're doing this with that, and well, where's the money? You got it.
I mean, the proof's in the pudding. Meta says we're going to spend money on the metaverse, stock tanks. Meta says we're going to spend money on AI, stock goes up like crazy.
Yeah.
Show me the money though, right?
Yeah.
Show me the revenue. Show me the profit.
The bill's going to come due. Just got to, again, be diversified. Not to say Meta won't crash because of this. It's just one. I think that's a special company, but if AI becomes a bit of a dud, you want non-AI type of companies. Like, I don't know how broad I have to be there, but like, I think that's pretty obvious.
Just stay diversified.
Yeah.
Just stay diversified, folks. That's all we're saying.
Yeah.
All right. Thanks. That was fun. I think maybe I added a fifth point there, and we can talk about AI once again, or rather, I'd add that to the agenda because I guess we went down a rabbit hole there. But the Abercrombie story I actually think it's phenomenal. It's promising that this technology has
really
real
awesome
merit.
Story. And support your local Radio Shack if you have one still.
I don't think there's any around me anymore. They're all closed. They all became like T-Mobile stores. I feel like all the Radio Shacks closed and T-Mobile moved in and took them all over. It's a perfect size store for them,
It is.
So yeah, I guess you would have been out of a job at this point. But
decades ago.
All right. Talk to you again soon.
All right, Chris. See you later.
Bye.